Gas, this really is something, isn't it? Silicon Valley Bank, or SVB, we have to remember, is the biggest U.S. bank failure since the global financial crisis in 2008. And like we've been reporting, there was another bank failure over the weekend, Signature Bank in New York. So that's two U.S. bank failures in a span of just days. Now, U.S. Treasury Secretary Janet Yellen said rising interest rates are the core problem for SVB. Here's why. So the U.S. Federal Reserve has cranked up interest rates 8 times over the past year to try and tame inflation. That is the fastest pace of rate hikes in some 4 decades. Of course, the Fed was forced to move very aggressively because it was slow to recognize that inflation was becoming a major problem in the United States. Now, when interest rates rise, bond prices fall. So why is that important? Now, during the pandemic, customer deposits rose rapidly at U.S. commercial banks as demand was weak, and that meant loan demand was weak as well. According to a note by Credit Suisse, deposits at SVB rose from $56 billion in 2019 to over $170 billion in 2021. Now, because banks were facing anemic loan demand, it put a lot of these customer deposits into fixed income securities to earn some yield, to earn some interest. Again, according to Credit Suisse, SVB securities holdings rose by nearly 4.5 times since pre-pandemic levels, and it bought these securities when interest rates were low. Now, when you push up interest rates by 450 basis points within a year, that will lead to a significant loss of value for your bond-related holdings. Remember, when interest rates rise, bond prices fall. Now, if SVB did not have to sell these securities, the situation would be a little bit better because the losses would just sit on the balance sheet of the bank. However, because customers at SVB started withdrawing these deposits in January, and SVB didn't have that much deposits on hand, it needed to sell securities at a loss in order to meet deposit demand, forcing the bank to realize those losses and face liquidity pressure. Now, as word got out that SVB was facing losses and financial pressure, that led more depositors to try and withdraw their money, which put even more pressure on SVB. The situation then turned into a classic bank run. Confidence in the bank was lost, and by March 9th, gas depositors were trying to move some $42 billion from the bank, making it one of the largest U.S. bank runs in the past decade. So there are what's called long and variable lags in monetary policy, gas, and it's becoming very clear now that the impact of the U.S. Federal Reserve's policy tightening is being felt.
Now, Michael, you mentioned the 2008 financial crisis. How bad is the situation compared to back then?
Yeah, well, the situation is a little bit different. When SVB first went under, the markets believed that this was an idiosyncratic risk, as SVB is a niche lender, making it a mid-sized American bank. Its customers are mostly tech startups, so its depositor base is not diversified, and the proportion of its uninsured deposits are high as well. Both of these factors heighten the risk of a bank run when the bank faces financial pressures. This is different compared to the subprime crisis of 2008, when the largest U.S. banks like Bear Stearns, like Lehman Brothers, came under pressure due to a system-wide crisis from exotic derivatives, from subprime mortgages and risky loans. Now, despite SVB and Signature Bank being niche lenders, U.S. financial regulators have already designated both as systemic risks. And that move is aimed to provide themselves with more flexibility to deal with the situation and to restore market confidence faster. Now, all customer deposits at these two banks have been guaranteed, even the uninsured portion above $250,000 US. This whole SVB saga, though, I think brings into question once more the ability of the world's largest economy to rein in its financial markets. If you'll recall, the Obama administration put into place the Dodd-Frank regulations back in 2010 with the aim of preventing another financial crisis from happening. Now, due to the importance of U.S. financial markets, tremors there will certainly reverberate around the world. However, just 8 years after Dodd-Frank was enacted, the Trump administration rolled back a number of these regulations to ease the rules on smaller and mid-sized lenders. In particular, the threshold for which banks were deemed too important to fail, that threshold was raised from $50 billion to $250 billion. SVB was below that threshold with assets of just over $200 billion before its failure. And these relaxed regulations meant banks like SVB did not have to undergo very important bank stress tests to check for its health and spot dangers earlier. Bloomberg, for example, is reporting that just 8 years ago, SVB CEO Greg Becker urged U.S. lawmakers to pass legislation that will allow his bank to skip these stress tests and resolution plans. So essentially, to skip tougher financial regulations that can better protect the bank's customers. Now, overnight, we saw the stock prices of several mid-sized U.S. banks plummeting. The question now is whether the failures of SVB, and Signature Bank will spill over to the rest of the U.S. financial system. And are we at the tip of the iceberg for more pressures in the U.S. financial system with the Federal Reserve hiking interest rates at such an aggressive pace? And likely we might see even more interest rate hikes to come. Gas?